How to manage risk with LEAPS options. Are you curious about how to manage risk when using long-term equity anticipation securities? Let's break it down step by step. LEAPS options are contracts that typically last longer than 1 year. This extended time frame allows investors to make informed decisions about stock price movements. First, it is essential to understand that when you buy LEAPS call or put options, your maximum risk is limited to the premium you pay for the contract. This means that unlike owning the actual stock, where losses can be significant, with LEAPS, you cannot lose more than what you initially invested. This defined risk feature is a key element in managing your downside exposure. Next, consider using LEAPS puts as protective hedges. If you own a stock and want to protect against a price drop, buying a LEAPS put option can act like insurance. If the stock price falls below the put strike price, the put option gains value, offsetting losses in the stock. The cost of this protection is the premium paid for the put option, which should be weighed against how much risk reduction you desire. Another strategy is to favor buying LEAPS instead of selling them. LEAPS options have slower time decay compared to short-term options. This makes buying LEAPS calls or puts a better choice for investors looking for long-term exposure while keeping risk under control. Selling LEAPS can expose you to larger risks due to the longer time frame involved. You can also combine LEAPS with other options to create defined risk strategies. For example, using covered call strategies with LEAPS calls can generate income while providing some downside protection. Additionally, spreads that involve LEAPS can help limit risk by offsetting premium costs and capping potential losses. Monitoring break-even points and expiration scenarios is also important. Understanding how the stock price relates to the LEAPS strike price and premium can help you make better decisions. For instance, if you buy a LEAPS put with a strike price of $42.50 for $3.50, your break-even stock price is $39. If the stock remains above this price, the put may expire worthless, resulting in a loss of the premium. If the stock falls below this price, the put gains value, which can offset losses. Lastly, be mindful of how you allocate your capital. LEAPS requiring less upfront investment than buying stock outright, allowing you to gain long-term exposure. However, over-allocating to LEAPS can still lead to significant losses if the underlying stock moves against you. Proper position sizing and diversification are essential practices for managing risk effectively. By understanding the defined risk nature of LEAPS, using puts as protective hedges, favoring buying over selling, combining strategies, monitoring key points, and allocating capital wisely, you can participate in long-term stock movements while controlling potential losses.